All right, this is the story that's hot tonight. India's largest real estate player, DLF, is planning to pick up a stake in DLF Assets, or DAL as it's commonly known. CNBC TV 18 exclusively learns that DLF plans to take a minority stake in DLF Assets to reduce its 5,000 crore rupee receivables burden. So on What's Hot Tonight, we ask, is this in the interest of the DLF shareholders? Joining us is SP Tulsian and our correspondent Nayantara Rai, who broke the story. Nayantara, let me come to you first, because this is all at the outset source-based information that you have picked up. But what are the details and what seems to be the motivation behind this proposed move?
Shireen, as of now, DAL owes DLF Limited about $1 billion. That's about 5,000 crore rupees. The entire business model was based, of DAL's was based on buying DLF's Grade A fancy office buildings, developing them, and then perhaps listing them in a REIT in Singapore. That was the initial plan in 2007. But then, as we all know, the capital markets crashed, and so did the REIT markets. Therefore, this entire plan went awry. So now DLF owes DAL about $1 billion. And ever since they couldn't list it as a REIT, the plan was then to raise private equity. Now, before that, anyway, raised money from D.E. Shaw as well as Lehman Brothers. Today, at today's date, DAL has raised about $1.1 billion as private equity. But that's not enough, and like I said, they owe $1 billion. And since last July, they've in fact been trying to raise another $450 million from a cluster of private equity investors. But we know today's times how difficult such a deal is. So if DLF were to take a stake in DAL, it would be in lieu of those receivables. Therefore, that's good news for DLF shareholders, simply because the receivables sitting on DLF's books would come down. However, that's what the brokerage firms say that we spoke to. Sources within the company, within DLF, say that no, this is in line with DAL's plan of listing a REIT. For any REIT listing to take place, the sponsor is a must, and therefore DLF is going to be that sponsor, and that is why DLF is perhaps taking that stake in DAL. But brokers have pretty much rubbished that claim and said that no, this is being done to reduce the receivables on DLF's books. In fact, JP Morgan and UBS had taken out a report on this in early March, and they both said that it's a good move provided the valuations are fair and is done at an appropriate cap rate, because then the receivables will go down. And the second advantage would be that instead of just having receivables on your book, DLF would gain access to the rental income that DAL will be earning over 9.5 million square feet. Shireen.
Nayantara Rai, many thanks for joining us with that information. Ms. Tulsian, let me begin you on this. Does this deal like this make sense, and is it in the interest of the shareholder of DLF?
See, Harsha, it shocks me when I have heard, Nayantara saying that DLF is planning to have a minority stake in DEL, and that needs to be done at an arm's length. If you just recall, the entire property of 9.5 million square feet has been sold by DLF to DEL for about 11,500 crore. If I take the undelivered property also as of date, of which 5,500 crore needs to be paid by DLF, by DEL to DLF. Now, if again the merger or the minority stake or the acquisition of stake by DLF has to happen in DEL, it must be again done at an arm's length valuation. Since the entire property of 9.5 million has been sold maybe about a year back, or maybe last property was sold in September 08 quarter, I presume that there is erosion in the value of all those properties, at least to the extent of 30%. That means the present value of the property must not be more than about 7,500 crore. You have a P equity investment of 1.1 billion. When that money was raised from Symphony, D.E. Shaw and Lehman Brothers, from 3 PE players, it was the rupee was ruling at around maybe 41, 42. Generally, we have a commitment with PE players, maybe of some assured return which runs, between 12 to 20%. If it runs into the dollar terms only, the present liability of PE could be anywhere about 6 to 6,500 crore, as against the present value of the property of 7,000 crore. So where DLF stands with their 5,500 crore receivables, they are taking the liability of about close to 6,000 crore of PE players in lieu of the property of having a value of 6,000 or maybe 7,000 crore on the maximum. Now, in the past, when they sold this property, they had a PBT margin of about 60%, on which the effective tax liability was 15% to DLF. That means they paid about 1,200 crore rupees tax as at that point of time by booking this sale. So if you see the entire thing, my entire 5,500 crore rupees gets vanished. Or even if DLF wants to take that property back, they must have at least a stake of 2/3, not the minority stake. Then where the PE player would stand. So I think this is the whole color or the whole scheme of merger merger, if it goes through, because since this is a source-based information, has, this is just to maybe to straighten the books that, okay, you have a 5,000 crore appearing in the books of DLF balance sheet as amount receivable from the associates or from the companies in which the promoters are interested. That will always be drawing the attention now with the auditors also, because when we are talking of the good disclosure and good corporate governance, this all will going to create problem. So probably maybe to straighten the books, you are acquiring effective value of the property not more than 1,500 or 2,000 crore in lieu of your dues of 5,500 crore, on which the company in the past have paid a tax liability of about 1,200 to 1,300 crore.
Right. Mr. Tulsian, how much credence or weight would you actually give to what our sources are saying is the company's point of view that this deal is actually being done on account of going ahead with the REIT listing? This is something that had been planned but was shelved on account of the REIT market, being caught by the meltdown globally. How much weight would you actually give to that argument? And do you think that makes sense?
See, Shirin, I agree that there is now problem in raising that $2 billion through REITs, because they had the IPO planning at that time. But if the deal has been structured in such a manner where DLF would going to remain a closely held company by the promoters of the DLF, suppose if the value would have would have accreted or got increased, at that time the company would have remained, DAL would have remained with the promoters of the DLF. But since now there is erosion in the value, you are not able to make the payment of 5,500 crore to DLF. You are in fact working out with this scheme. That means if there are losses, put that into the books of DLF. If there are profits, that is the property or the value or the assets of the promoters in their individual capacity. So if with the change in the developments or events having changed over maybe last 6 months and they are unable to come out with a DLF office trust IPO in Singapore, they have worked out this scheme.
All right, Mr. Tulsian, many thanks for joining us with those perspectives.